Time and time again, I see beginners getting caught in traps. CFD trading, chasing yields, investing in stocks just because they've seen big drops, and perhaps the worst of all, trying to buy the stock and then sell after the ex-dividend date. One of the most silly ideas. If you're not willing to own a stock for 10 years, do not even think about owning it for 10 minutes. In this video, I'm going to cover the portfolio crushing sinkholes that even moderately experienced investors can be caught trapped in. All this and more on today's Income Investors. Trap number 1. Chasing yields. Chasing yields is a recipe for disaster. I've seen beginners blindly investing in extremely risky companies like mortgage REITs in the midst of an economically devastating worldwide pandemic, without having any knowledge of how they work or even how REITs themselves work some of the time. If a stock's yield is abnormally high, it could be because the stock price has dropped. Remember, yield is just dividend divided by the share price. Worse still, the share price might have fallen for a reason you aren't aware of. Maybe the company is having huge financial troubles and the dividend will be suspended next week. Just when you thought you were getting the deal of a lifetime, it blows up in your face. A good rule of thumb is that the higher the yield, the riskier the company. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Trap number 2. Trying to time the dividends. Why don't you just buy the stock and sell it after the ex-dividend date? Easy money. If only it was that easy, we'd all be millionaires. Why you can't time the dividends. 1. The dividend is usually already priced into the stock. You're essentially paying your own dividend if you buy just before the ex-dividend date. 2. The bid-offer spread on all stocks means that you can only sell at a slightly lower price than you bought. For example, if you bought a share at £20 and immediately sold it, it might sell for £19.80. With these factored in, you might as well just buy the stock for growth and forget about the dividends, because by thinking this way, you're putting your chances of making money at a disadvantage. Trap number 3. Investing in foreign companies, not knowing the taxes and fees you're paying. Taxes on foreign dividends can be extortionate. They can be the death of your portfolio. This would give rise to the idea that if you are an investor, a significant portion of your holdings should be domiciled in your country of citizenship, or countries in which your country has a tax treaty with, such as the US and the UK, which reduces the US dividend withholding tax to 15% from the original 30%. This is if you fill out a W8 Ben form. Trap number 4. Owning too many stocks. It is correct that owning many stocks reduces the risk of losses, but it also reduces your rewards. In addition, it is hard to keep up to date with the news of a large stocks portfolio. I would recommend a maximum of 30 stocks in your portfolio, but I personally just have 17 in my portfolio, and I'm considering reducing it. My way of thinking is, why would I invest in another pharmaceutical company if I believe AstraZeneca is going to do well? Quality over quantity. If I want excessive diversification, there's always ETFs. Trap number 5. CFDs. Just don't. 80% of CFD traders lose money. The platform is riddled with high spreads and overnight charges. Don't use CFDs unless you realise your chances of making money are very slim. Just don't. Thanks for watching. Hopefully after this video you won't meet the same fate of so many new investors who seek to make money fast. Remember, investing is easy, but time is your best friend. Allow your holdings to slowly grow and your chances are you'll be a winner. Please like, comment and subscribe as it helps support the channel. Also, if you want a free share up to £100, sign up with the Trading 212 link below and deposit £1 into your account. Thank you again for watching. See you next time.